Hello, can you hear me? Can anyone hear me?
Yes, we can.
Okay, okay. Right, okay, so let's start. I think I have to make one correction in the last. I think I have also posted to the WhatsApp group, but I just want to show you what is the correction. And that correction was about calculating enterprise value, which we learned in a lesson number 2. So I have corrected that. So in your previous lesson, I told you that enterprise value should have minus cash and plus debt. Actually, it is other way around. So because if you are buying company, you are paying them all the market cap. So whatever the outstanding share value multiplied by the price. So that's going to be the market cap. Whatever cash company has, it's yours. So you're not going to pay that because you are buying the company. The debt you have to, sorry, I think this slide is also not correct. Hold on. Let's see. Let me see if I have corrected here. Okay, so I have corrected here. So if you see the market cap, and then you add the debt, and then you reduce the cash, and that will give you the enterprise value. So in the previous lesson, by mistake, what I told you is market cap plus cash minus debt. But after the lesson, after the finishing the lesson, it just come to my mind that, and I double checked it, and then it makes sense that its enterprise value should have the market cap, subtract the company's cash, and whatever the company's debt, you add in it. And that's how the enterprise value should come. So just make a note of this enterprise value. During last lesson, about there was one second correction was that I have said revenue instead of the cash flow. And that was when I was expecting, I was explaining the jump on the Apple's cash flow. It's supposed to be the cash flow, not the revenue. So there were two minor. The enterprise value is the one, is the major one, but that another one is the minor. But just make a note of this, that enterprise value means market cap reduced by cash and add the debt of the company. Okay, so with that, we start with this new one, lesson number 3. Okay, so how many of you able to do exercise? I mean, the given exercise. Did anyone try to do it? Has anyone ever tried to find the free cash flow for at least one company? Okay, so we going to the lesson number 3 now. And let me see what is. Okay, so Tia is saying that I tried but didn't understand it. So Tia, why don't you open up your mic and ask me what things you did not understand?
I'm not too sure. I don't remember, but I just got confused in, I think, putting it in.
Okay, so what you can do is also this, the recording is available. You can re-hear it and you can go through it again and try it again. So you said you watched the video, but you still did not, was confused. You were still confused. Okay, what part did it make you confused?
I think I wasn't sure how to enter to get the percent, and like my calculator looked a bit different.
And for which
I used a calculator on another device, but maybe I can just, show it to you next time.
And for which company did you try to do?
Coca-Cola.
Coca-Cola. And was it yearly or quarterly? You try to do the enterprise value and everything, or just the free cash flow and owner earning?
I tried one of them. I don't remember which one.
Okay, so and if I have a time today at the end of the lesson, I can go through that. But let's go to this new lesson. And anytime during the week, after recording the lesson, if you don't understand, you can always send me the message on a WhatsApp, and I should be able to spend 15-20 minutes to explain you, and you should be able to do the exercise, because the exercise is important, because as we go progress towards the new lessons, if you don't understand the previous one, then it's going to be tough for you to understand these new things. And because everything is stepwise. So if you don't know how to do first two steps, when I explain you third step, it makes you more confused. But since I just have to finish this one in 4 or 5 lessons, I have to do this, and you guys, I hope that you guys do the exercise and ask me any question anytime on our WhatsApp group where you have enrolled, and I should be able to answer. Even if you are confused or anything, just ask me the questions. Okay, so now many times we go to the lesson number 3. Okay, now it is getting a little bit complicated. We are going to do a lot of calculation here, because we are at the stage that we will start to find it out the value of the companies per share and see if that value is matched with the market price. If the market price is over our calculated value, then we just pass that offer. We don't want to buy that stock. And vice versa. If it's down, we're going to buy the stock. So many times in India, when I grew up, most people says that, and there is a general notion also, that stock market is gambling. Many will tell you the same way, that market is gambling. And today I want to show you why market is not gambling. So I want you to let me go to, okay, let me explain you. I have explained you free cash flow and owner earning in the second lesson. What I'm going to explain you today is return on equity. And I'm just thinking that, should I explain you a bit? So return on equity, if anyone can tell me what is equity? we did 2 lessons. In the second lessons, we learn about the shareholder equity. Anyone can tell me what was the equity? What we learned about the equity? There was a shareholder equity we learned in a lesson number 2. It is also known as a book value. Okay, so return on equity, equity means all asset minus all liability, and that will come up as a shareholder equity. When you divided it by outstanding share, it will give you equity per share or book value per share. Return on equity means if book value is $10 and if company is making $2 net earning after paying taxes and everything, the return on equity will be 20%. Because if you see here, you invested $10 in the company and you got $2 back in the form of earning. So the return on equity should be 20%. The return on equity, Warren Buffett likes return on equity so much. Many times he makes decision based on return on equity. The company that has produced consistently high return on equity will ask you high premium. Because when we talk about book value, when we talk about when we say that Coca-Cola has this book value, whoever runs the Coca-Cola have only that much money that is in the book value. It doesn't matter that Coca-Cola is trading at $65. That is the market perception, that is the market price market is asking. That price, that money is not there for the person who is running Coca-Cola. So for example, Coca-Cola is trading right now at $62.38. Now, if we go to the book value, which is under statistic, and we can find the book value per share. The book value per share is $5.74. Remember that CEO of the Coca-Cola have only $5.74 per share to play around. That $5.74 is earning how much? Let's say this is the diluted earning per share, $2.37. So what is the book value return on equity? It's $2.37 divided by 5.7400. Return on equity for Coca-Cola is 41%. I mean, you will see very few businesses earning high return on equity. Once the business started to earn high return on equity, people are going to pay more for price to book. So for example, here, people are paying about 13 times more, 13 times of book value of Coca-Cola. Why they are paying 13 times? Because Coca-Cola is earning, if you see here, return on equity, is earning 42%. Return on equity is 42%. If This is just for 1 year, but just think about it. If it's keep doing this for last 10 years, the market always going to pay high price. Market always going to ask for the premium. You cannot find Coca-Cola trade at $5.74. The market is efficient in that sense that if they figure it out, something is working nice, return on equity, producing much more money, then they're not going to let it go for $5.74. If the Coca-Cola is trading at $5.74, what Buffett will do is he will sell everything and buy only Coca-Cola, because he knows that $5.74 he can recover in 2 years. And so the Coca-Cola will never trade at $5.74. It's because the return on equity is generating whatever shareholder money is included, whatever the shareholder money are there, the return on equity generated by Coke is so high that you have to pay the price to premium. If you see any company like 3M, this is another good company, industrial company. If you see, it's also producing return on equity 38%. And let's see, people are paying $128 divided by. People are paying 5 times the book value. Yeah, because 3M is also producing high return on equity. When company produce high return on equity, it's always going to be go on a premium. You cannot find on book value base. Like you cannot find this 3M at $30. If it's trading at $30, I will sell my whole portfolio and just buy only 3M, because it doesn't make sense. So return on equity is very important. And I'm coming back to the thing, example, that why stock market is not gambling. And if somebody tell you that stock market is gambling, you can give this example to them. So I will show you. We go back to Coca-Cola. Let's say the return on equity, I just want to keep it 40%, okay? Now, in either situation, I have to find it out last 10 years of return on equity. I don't have that data. But assuming that Coca-Cola is producing 40% return on equity for on an average for last 10 years. What other things I want to see is the book value. So the book value is $5.74. So I want to make a note of that. And this is the first method where you can start valuing the companies. So this is called determining company's value using the return on equity. Let's limit it for 5 years. Okay, Coca-Cola is earning how much? It is earning $2.37, and it is here. Okay. So we're going to put earning per share $2.37. Now, when Coke is earning $2.37, it's not keeping all $2.37. What it is doing, it's part of earning, it gives you back in a form of dividend. So we will find the dividend. So let's say, where is the dividend rate for Coca-Cola? So from $2.37, it is paying $1.70 in the form of dividend. So what it's doing, it's getting $2.37. Out of $2.37, it pays you $1.70 back. If you see the payout ratio, this is called payout ratio, it's 71%. As company get mature, the payout ratio rise. Generally, payout ratio should be around 50% is good. For Coca-Cola is exception. It doesn't have that much debt. But usually the payout ratio should be around 50%. So when I say payout ratio should be 50% means when it's earning $2.37, it should pay the dividend instead of $1.70. It's supposed to pay dividend $1.18, 50%. But Coca-Cola is paying 70%. So I just want to make here note here. Payout ratio is 70%. Okay. Return on equity is for last 10 years. Okay. So now what it does that because it's Coca-Cola gave you back $1.70, it is left with 67 cents. So what Coca-Cola is doing is out of $2.37, 67 it is adding to his to its equity base. So now the book value will have $5.74 plus new book value for year 2023 should be $5.74 plus 0.67. So the new book value is going to be $6.41. Okay. One more thing I just want to note, how many times it's paying to the book value. So Coca-Cola is trading around $62. Book value is $5.74. So it's around 11 times. You are paying 11 times the book value. So now here is again $6.41. We can calculate, and this is only possible for companies like Coca-Cola, where if it's a cyclical company, where 1 year it's making $3 and another year it's making negative 50 cents, this method would not work. This is working for Coca-Cola because it's consistently producing that kind of earning. So what we can do is that we have a new book value now. It's $6.41 that in year 2023. Now Coca-Cola, as we say that the last 10-year return on equity was 40%. So we can predict that Coca-Cola, how much Coca-Cola will make in 2023. It's going to make 40% of this new book value. So it's going to make $2.56. Now, out of $2.56, 70% it's going to pay out as a dividend. So it's going to increase the dividend to 1.79 cents. Now it's left with $0.76. This 76 cents will be added to this book value and create the new book value for year 2024. So for year 2024, $6.41 plus, this is going to be its new book value, $7.17. Again, Coca-Cola is going to produce 40% return on equity on its book value. So we can predict that in year 2024, Coca-Cola will make $7.17 multiplied by 40%. So the earning, it's supposed to make $2.86. Out of $2.86, 70% is paying out in form of dividend. So now the dividend amount would be around $2. It will keep 86 cents for itself. Add that this 86 cents will be added back to $7.17. So the new book value is now for year 2025. It's $8.03. Again, we can predict 2025 earning because it's on average, it is earning 40% return on equity. So $8.03. Now it's going to make earning per share $3.21. Out of $3.21, it will pay you dividend, which is dividend payout ratio is 70%. It's going to increase the dividend $2.24. Whatever left is going to be added back to its book value. This 96 cents going to be added back to this $8.03. So the new book value will be approximately $9. Again, based on $9 is going to make 40% return on equity. So the new earning on year 2026, the Coca-Cola should make around $3.60. It's going to pay dividend again 70%. Dividend is going to be $2.52 and return earning is going to be $1.08. This $1.08 will be added to $9, and then it will keep continue going on. Okay, so based on our calculation, what we figure it out. Now, this is not exact science. I mean, you may see that Coca-Cola make $2.20 in year 2022 instead of $2.37. Or you may see it makes $2.70, and what we predict is $2.37. But on an average, we going to be the earning is going to be fluctuating around these figures. Because Coke is a steady business, branded business, it's not a cyclical. So you will hardly see that what happened in 2023, its earning goes to zero, or its earning goes to minus. Something happens, people stop drinking Coca-Cola for that year, and earning went to minus 50 cents. That will not happen with Coca-Cola. And that's why for companies like these, which are producing high return on equity for last 10 years, you can use this calculation to calculate it for the future 10 years. What would be the price of Coca-Cola in a 10 years from now? Now we will find it out price for the 2026. Again, this is not an exact science, so we're going to get an approximate value. Okay, let's say the market is paying right now 11 times to book value. What is our new book value? It is $9. Can anyone please tell me what can be the Coca-Cola price in year 2026? Just estimated price. Okay, let's go back again. When book value was $5.74, people were paying 11 times to book value. And that's why the Coke was trading around $62. Now this, you must know, and you should be able to answer. Book value now increased to $9. We are assuming the market is still paying 11 times to book value. What would be the new market price for Coke stock? Anyone? We have to get this thing clear. Okay. Again, I'm saying, when Coca-Cola has a book value $5.74, you were paying 11 times to the book value. So market was paying around $63 for Coke stock, which you can see here, right? How much they are paying? Around $63. My question is very straightforward. Now book value is $9. If you convert and if you assume that market is going to pay 11 times book value, very good. Yeah, good. So I think that people get it. Okay. So the new price would be $99. And I just want everyone to get idea about this. Okay. So when people were saying that market is gambling or stock market is gambling, it's not gambling, because what's going to happen in year 2026, we have calculated book value $99. Now, this is estimate, okay? So what can be happen in year 2026? Three things can happen. Coke can trade at $99. What you have traded? Coke can trade over $99. Market was that at that time, market was the bull market, and people were making good amount of money in the stock market, and people were, instead of paying 11 times to book value, they want to pay 13 times book value for Coca-Cola. So 13 times book value, market is, Coca-Cola may be traded at $170, or market is in the bear market territory, and people don't want to pay that much premium. So they used to pay 11 times, but now they want to pay 7 or 8 times because market is in the bad condition. It's in the recession mode or anything. So if we count as a 7 times, then 11 times to 9 times, okay, 9 times, and we have a new book value is, okay, 81. 81. Okay, so now what you have predicted using this table, that if you pay right now for Coca-Cola $63, after 5 years, so year 2026, either you would have $99 as you predicted, you may have more than $99 because market was very enthusiastic and they want to pay you more, or market is depressed and they want to pay you $81. What we can do is we can average out these three values, okay? So we will say 99, 117, 81 divided by 3. Wow. Okay, so the average price comes $1.99. Okay, now here is my point why I am saying that market is not gambling. Okay, in year 2026, if by chance Coke is working fine, everything is working fine, but there is huge recession or there is war some part in the world, and market is selling me Coke for $27, I'm going to buy as much as I can buy because I know the value should be around $99. This is the temporary setback. I know that Coke, people are drinking same amount of Coke. I know that Coke is still making more money. I know the Coke balance sheet is good. I know that Coke is, it's just the market. Market thinks, market is very, very pessimistic. And market says, oh, take my Coke share for $27. You will not find $27 trading Coke in 2026. It will trade more than $63. That I can assure you. How much more and less, I don't know exactly. Nobody knows. And this is the estimate. So we can say, if we, based on our average price of $99, it is 50% more than what we paid in 5 years. So that's why I say that market is not gamble. If you do the earning based thing, if you know the company, Nobody is going to sell you Coke at $63 after in year 2026, because that would be based on is earning $3.60. If they are still selling me at $63, I will buy with both hands. And that's where Warren Buffett comes. Whenever market is very pessimistic, and Warren Buffett knows that there is no problem with the company, and market is giving him Coke for $63, he will grab it with both hands. And that's why he is billionaire. And that's why we have to have the knowledge about how to valuing the company. Here you got idea. I'm not saying that this is exact. Okay, you got idea that in 2026, Coke should be traded around $99 or something on average. What you can also do is you can find it out the rate of return. Okay, so to find it out the rate of return, I have showed you before the calculator. So the present value of Coca-Cola is $62.63. Okay, we want to find it out the rate of return. How many years? 5 years. Compound frequency yearly. Future value we know, we estimated $99. So Coke is giving us rate of compound interest 9.58%. Now that, so every time that return is going to be compared with the other opportunity. If you want to become a sleeping partner with somebody, he's opening liquor shop or Subway, and he's paying 20%, then you will buy, then you what you will do, you will go for that route because you are getting 20%. If you rent a property and after renting the property, you are getting 7% year-to-year return, then I will go for the Coke because 7% plus you have to do a lot of work for rental property. Where in Coca-Cola, case of Coca-Cola, you just have to sit and relax. So all investment eventually started to compare with other opportunities. Now, what we usually compare when we talk about investment, just a second. So what we're going to do, what usually people do, or when we compare the investment, you compare the investment with the US government bond, okay? Because US government bond are risk-free. Why it's risk-free? Because it's backed by US government. So you want to find it out that 5%, 5 years US government bond, how much they are paying right now. So we go to, it's called treasury bill, T-bill. Okay, so here it says that right now, if you buy treasury, which is the risk-free bond, you will get return of 3%. Coca-Cola will give you return of 9.5%. So I will go for Coke. I know it's a little bit risky, but Coca-Cola, Apple, those companies, they cannot go wrong except somebody do the cheating in the accounting. If they do accounting fraud, which no one can figure it out, because if the numbers are wrong, then nobody should within the company. Hi, Tia, what was the message? Yeah, within the company, the fraud within the company. Yeah, someone, what they do is they manipulate earning, and yeah, they manipulated earning wrong way. Then even Warren Buffett cannot figure it out. But Warren Buffett figured it out many times because he reads a lot of annual report, and in annual report he can find it out irregularity, which he did with the Enron. He was reading annual report, and there are so many things in Enron annual report were bothering him. He could not understand because the company doesn't want you to understand, because they were doing fraud. So Warren Buffett can figure it out because he's reading a lot of annual report and stuff. But it's hard. If that's the only risk in a stock market. It's if your CEO is dishonest, you're going to suffer. But apart from that, for company like Coke, or even for company like Coke, if somebody does the fraud, I will buy the more share at a deep price, because this is one-time solution. There is nothing wrong with the company's function. It's just somebody has put the wrong numbers, and market has over exaggerated the situation, and they sold the shares, and you can get the opportunity to buy at a lower price. But if someone now tell you that market is gambling, you can show them this calculation. Market is not gambling. Market is like you have the Subway that increasing the revenue after 5 years. You have a Dunkin' Donuts business, it's going to increase in the revenue after 5 years, 6 years. The problem with the Subway, Dunkin' Donut, you will not see 10%, 11% growth. And that's why when you buy Subway or Dunkin' Donut, you pay 2 or 3 times book value and not 11 times book value. But ultimately, it's like a business. This is a business, it's growing and growing and growing, and you are getting things out of that. So if we come back to here, where was my? Did I close it? Okay, so we learned return on equity, and how the return on equity, this is the first method out of, there are 3 methods. You can figure it out. Actually, there are 4 methods. The first method is based on this return on equity. Second method is based on price to earning ratio. Third method based on price to free cash flow. And fourth method is a free cash flow, by doing future cash flow and discounted it to the present value. Now, I initially used to do that. I have probably have some, let me see the Excel sheet. If I have, I can show you. But now I'm not doing anymore, because you just want to keep the calculation simple. And as I said in the lesson number 2, that free cash flow is is also not foolproof. You can go wrong in free cash flow. But I used to do these all things. So what I do is, so if you see Google Financial Health, I'm owning Google from 2014. So I made a chart here, and in 2020, it was only half quarter or something like that. But you can see very quickly, like you can, if you are interested, you can always do these things. Every quarter I was doing here, and this is yearly based, but on a yearly base, you can do this thing. And you can quickly find it out if something goes wrong. But I'm not doing anymore. But if I will show you, there is another thing that I made a decision based on this. Okay, this Becton Dickinson is very good company, and still is very good company. They are supplying needles, syringes, all the IV supplies. But if you see here, the return on equity is started to drop. Okay, which is okay. I had add one more thing here. It is called interest coverage ratio, because they were buying a lot of companies and their debt was very high. And I want to find it out if the interest they pay for the borrowing money, what interest they pay, is it covered by the free cash flow or not? So you can see that they used to have the 8 times coverage. So for $8 of free cash flow, they have a $1 debt, which in 2018 dipped to $2.80 debt, $2.80 free cash flow for $1 debt. So these are like warning signs. Okay, these are warning signs in the sense that they are taking a lot of debt. It's a similar, like if you are earning 100,000 and you buy the house for $4 million, it's way out of your reach. And sometimes companies do that. The CEO comes, nobody asks them, and nobody asks question to him. He kept adding the stuff. And as I said, that many times CEO are very good in invention, in running the company, but they are not very good at financial. So they don't see all this stuff. And another thing also here is the warning sign is, see this, they've been issuing more and more share. So I sold my Becton Dickinson share in 2020. I had it from 2009. But you can here see that cash flow versus capital expenditure is getting very, very close. No, here was fine, but I think this is the half year, that's why. But you can also see here book value versus debt I have made. So they used to have a $20 debt. Book value was $24. That was $35.55. Okay. Yeah, so I used to do all those this stuff, but not anymore. I just look quickly on the Yahoo Finance that if the debt is going high, I don't even invest. So in this case of Coca-Cola, if you see the debt, total debt is 42 billion, okay? And we deduct $10 billion cash. So they have a 32 billion outstanding debt. But if you see net income is about 10 billion. So they can pay off their debt within 3 years. If they can pay off their debt within 5 years, I don't have any problem to buy. It's getting a little bit tricky, and especially now because interest rates are on rise. And I will show you another example, and that's why I'm not investing in that company. Okay, Gap. They are the good fundamental company. You know, they own Old Navy, Banana Republic, branded clothes, and everything is fine. But there is only one red flag, it's here. See, the total debt is 6.47 billion. So if I remove the cash of 845 million, they have a debt of outstanding debt of 5.62 billion. Okay, now I come here, the net income is negative. Sometimes what happened that for that given year, they have taken non-cash impairment charge or something like that, inventory write down. Sometimes the net income goes to the negative. Was it supposed to be subtracted or divided? Okay, so divide, so the debt, yeah, you have to divide it. So your net on total debt divided by your net income. Subtracted, yeah, what I did is what I subtract is the cash. See here, it's a total cash. So company has 845 million cash. So you cannot say that company has a total debt of 6.47 billion because they have the cash of 845 million. That's what I subtracted it. But here again, now here when I come here, okay, net income is in negative, so I cannot do anything with that, but I can go to EBITDA. And EBITDA is what, 835 million, okay. So if what was it, 6.47 billion minus 0.845, 5.62 billion divided by 0.835. So that is going above 5, ratio of 5. So I'm not, even though it's very, very tempting to buy Gap, I'm not buying it because that ratio, whatever the income is, whatever they are earning, the debt ratio is over 5 times, and it gets difficult. Yeah, they have to sell something. Either they have to sell some properties, or either they have to issue new shares. In both cases, it will dilute it. So, and sometimes you want to see also like what the other competitor in the same industry are doing. So you cannot blame the Gap as a bad balance sheet. Okay, if every single clothing companies like American Eagle, you see, let's say American Eagle, okay. I want to go American Eagle. American Eagle has 1.87 billion debt minus 0.228. So they have the 1.64 billion debt, and the net income is only 355 million. Which is good. Okay, I can buy it. It's under five times. I can buy it. But if you check with Abercrombie and Fitch, the net is 1.16 billion debt minus 0.468. So their debt is only 0.692 billion, and net income is around 204 million. So if I have to pick one company in the clothing, I will go for Abercrombie because they have a very least debt, and all of them are trading at 52-week low. So this is like 52-week low. American Eagle is trading at 52-week low, probably near there. Gap is probably trading at 52-week low. See, so if I have to choose one, and I have to make a good, I'm thinking that I want to make one good investment in the retail clothing, then out of these choices, I can pick the Abercrombie Fitch because I like the brand, I like the business, and specifically I like the balance sheet because they won't have any problem. The Gap going to have a problem. If once the interest rate goes high, it's getting hard, it's getting tough for Gap. Somebody has to buy out Gap, and you can just avoid that things. So in this lesson, what we saw today is based on we saw the method where how we can estimate future price of company using the return on equity. The free cash flow or owner earning I have explained in the lesson 2. Next lesson, I have also did some in the debt section. I just want to tell you that don't go over 5 times to net income. Now there are companies, they have the high debt, okay, and you will see that Warren Buffett is probably buying it, but then it will also sell it out quickly. See, when Warren Buffett bought Verizon, okay, Verizon, AT&T are good company, but the problem is that the telecommunication business requires a lot of investment. So here, if you see, their debt is 182 billion. Okay, just 1.79 billion cash. And this is exactly the same thing with AT&T. So I am not investing for dividend or for anything to Verizon or AT&T. I'm not saying that something happened to them, but they will just probably give you the dividend. The appreciation will never come because they require high capital intensive business. They require a lot of cash infusion. The only good thing about AT&T and Verizon is they have a very good cash flow because there are only 3 major wireless carriers. T-Mobile now is merged, Verizon and AT&T. So they have a good cash flow, but they have a lot of debt. If you see this net income is 21 billion, if you divided net income by 21.4, they are almost about 9 times, 8.5 times they are borrowing than their net income. if you see the same thing with the AT&T, all telecommunication companies has this problem. If you go here, here there's a good cash. So 237 billion, 0.59 minus 38.63 billion, 198 billion. The net cash, net income is 17.14 billion. But they have 12 times more debt. It takes them 12 years. I don't want to go over 5 years. And so we also went through the debt thing, and that is the only thing you have to look for the debt. Just make sure that the debt is not going over 5 times. And while AT&T and Verizon is good company, they will give you good dividend. But there are many other companies, they require very less debt and they earn very good money. So if we just have to select top good 20, 25 companies, then we can just exclude it. I mean, if you are a fund manager and you don't have any other choice, then yeah, you invest in AT&T and Verizon. So we went to these 3. Now, next lesson, what I will do is I will go how to find it out the future price based on a price to earning ratio, how the price to earning ratio will affect, and we will also find it out the same way if you don't want to use price to earning ratio to calculate the future value, you can also use the free cash flow per share or owner earning to find it out the future value. Once you find it out the future value, we have to go to this calculator here and you have to put present value, interest rate, the one we want to find it out. Period based on your whatever 5 year, 10 years, whatever you have find it out the future value. If your future value is based on 10 years, put 10 years. If future value is based on 5 years calculation, put 5 years. And then finding out the interest rate here. So like you see, if the interest rate come 3%, okay, then you know that it's not worth to take that risk, because anyway, the government bond is paying you 3% without taking any risk. Then why would you invest in this company if after 5 years, you only going to get 3% rate of return on average? So we will look into that in the next session. But if you have any comment or any question, just ask me on my WhatsApp investment lesson, and I should be able to answer that. Okay, so we will meet now next Wednesday, and the next Wednesday we will go through this price to earning ratio calculation in price to free cash flow. And then what we can do is one more lesson after that, we will just go and select at random stocks, and we will try to see if it makes sense to purchase them. I will show you the way I do it in a quick way. Does it make sense for me to buy it or not? So we will go through one entire lesson on that, and that should give you very good idea, and that should also give you very good grip in finding out the value of the company, or you want to invest or not want to invest quickly. So like nowadays, because I'm doing this since 2009, I don't have to go for all the detailed calculation, and I just do like 5 or 10 minutes I spend, and I can get idea if I want to invest or I don't want to invest. So that we will do in the, so we would have 2 more lessons, And after that 2 more lessons, you would have all the knowledge what I have acquired since 2009 through trial error, through books and everything, through Warren Buffett annual letters. You would have in this 4 or 5 session of YouTube thing the what I'm recording right now. So with that, we will meet again next Wednesday, 5 o'clock. So if you guys have any question, you can ask me. Otherwise, I will stop recording. Anyone have any question before I close the Zoom meeting? Okay, thank you, Tia. Bye. You're welcome. Okay, so we will meet next Wednesday then. Bye.